Hi guys, in this video I'm going to be going through all of LuxAlgo price action concepts. I'm going to break down each feature in this toolkit. I'm going to explain how to use it. I'm going to show you simple methods to understanding it, and I guarantee by the end of this video you'll have a 100% understanding of what is actually going on your chart. Because for maybe a newer trader who loads this up, you're like, whoa, what is going on? So let's get right into it. Let's open up the settings. Let's start with our market structure. You see internal and swing. So what these are these labels. You see these choch plus choch, break of structure. So let's break down what those actually are. So first off, we have internal. Internal are smaller structures in the market. So they look at less candles. They look at a small range of candles, and they're looking for small things, small price action that occurs in this small area. So these dotted lines, for example, are break of structures that are internal. So BOS stands for break of structure. So what it's basically saying is we have a structure here and we have some kind of support line here, and we're breaking through this support line and we're bouncing up, and this is another support, but we're breaking through. So we're breaking at these points. So it's a break of the structure in the market. So if you see a red break of structure, for example, that could mean, hey, maybe the market is coming down. It's continuing its trend. You see break of structures in trend continuations. So we see we're in some kind of downtrend here. We break our structure here. Bam, we break through. It's labeled BOS, break of structure. Bam, we break through, break of structure. And of course, we see the opposite for green. We see break of structure bullish, break of structure bullish. We're breaking above, we're breaking through. You can use these as entry, buy signals, just some confirmation in a trend. So these show trend continuations. Next up, I want to note choch. This is the second type of thing you'll see on your chart, and it stands for change of character. So the market has a character. Either it's bullish or it's bearish. So a change of character means the market is changing between bullish and bearish. So for example here, we see a choch plus. Don't worry about the plus for now. We'll just look at the choch. Basically what this is saying is, hey, the market was in an uptrend. Now it's changing its character, and now we're in a downtrend. So it's basically a type of reversal signal. And here we see another choch. This isn't a choch plus, but we'll get into what the pluses mean in a second. And this means, hey, we've had a downtrend. We see a green choch. Now maybe it's time for an uptrend. You see, we have this downtrend, choch, meaning, hey, the market was in a downtrend. It's going to change its character, and now we're in an uptrend. And these are real time, so you can in real time trade this. So the main difference between a choch plus and a choch is basically a choch plus is preceded. So before the choch happens, there's an early sign of a market reversal, such as a failed higher high. So a choch plus is basically a little bit of a more confident change in structure. But if you're a newer trader and you're just getting to grips with these kind of terminologies, you can use them in exactly the same way. Next up, we see choch, and we see this choch, but it's a solid line. So this, what we see here, is a swing market structure. The solid lines are swing market structures, and these are on higher time frames because they're swing structures. So we see here the market is moving, and we break this choch. You see this choch? We break this structure here, and then because it's a green choch, we go on a bullish run here. So solid structures with solid lines denote swings. They're higher time frames. You can see here we have a break of structure. So we're in some kind of little retracement, and then we break above and we go up a little more. So the solid lines are swing structures. They work exactly the same. They're just on a higher time frame. And then finally, we see EQH and EQL. EQH stands for equal high. Basically what it's saying is we've done this in the market. We've bounced off here, made a high. We've bounced off here, made a high. And these highs are similar levels. It's an equal high. And basically it's a reversal sign. It's bearish. So when you see the equal high, maybe the market's going to come down. And we see here an EQL, or an equal low, where the market may have double bottomed. Here we make a low, here we make a low, and it doesn't reverse straight away. We come down a little further, but then we reverse. So it's a reversal sign. So use equal highs and equal lows as reversal signs. And then in the dashboard as well, you see here the Choch multi-time frame scanner, and it will look through the 15, the 1 hour, the 4 hour, and the 1 day to look at the Choches on those time frames and see the trend of the market. So we see here all of them are red. So Ethereum on the 15, the 1 hour, the 4 hour, and the 1 day is bearish. All of the Choches are bearish. So now I've explained the market structures, I'm going to turn them off because you can turn them off in the settings very easily. If you don't like the market structures, remove them. It's that simple, and we can turn off the equal highs and lows as well. We can turn off the scanner. Let's take a look at the color candles. So these color candles are basically based off those market structures. So I can enable them again, but when we see green candles, the market structures are starting to become bullish. When we see red candles, they're starting to become bearish. And you can see it's trend following, red for bearish, green for bullish. Very, very simple. If you like candle coloring, you'll love that feature. Next up, the order blocks. So during the current price action, we see order blocks, and this is what you will see on your chart. You will see these. You may be intimidated at first, but they're very simple. What we see here are support and resistances. These are levels that the price bounces off of. You can see here the price bounces off of this, it comes down. It bounces off of this here, it bounces up, it bounces off of this. So they're acting as support and resistances on your chart, meaning they're great for take profits, stop losses, or whatever really you want them for. So next up, we see inside the bar, we see these metrics. So this is the percentage of the volume that's occurred within this order block when it was generated. So these 5 order blocks add up to 100% of the market volume. But you see this monster down here, 57%. So this order block saw most of the volume in the market. Because it's 57%, this means it's a really, really, really strong order block. It's more likely to act as a support. So, for example, this is 13%, so it's not as strong. So it may bounce one more time and then break through it. But we'll find large support on this because of that huge amount of volume that accumulated on that order block. And then we see here next to the percentage, that's the actual quantity of the volume. So look for that higher number. The higher the number, and of course it's out of 100%, the higher the number, the more significant. When you see something like 57%, that's massively significant. When you see something like 6%, not too significant. Then we see the volume that went into constructing the order blocks using these green and red bars. So let's look at this order block up here, for example. We can see when this order block was generated, the data that we looked at, most of it was bearish volume. We can see this large red bar. Most of it was bearish volume, meaning, hey, this order block is really bearish. Bears and the sellers really like to sell at this level. We can see they totally dominated the bullish volume, and we can learn a lot from that. We see here again, the bears totally dominated at this level. And even here, it is very interesting. We can look at this, and we see the market came down and it bounced off. But for some reason, we see there's more bearish activity here. Does that mean, hey, the bears were in control? Well, no, not necessarily, because this could be a level that buyers deem really significant in the market, because despite all of this bearish volume, this sell, the bulls stepped in. They gave one big green candle. This was a level they were really interested at buying at. Now, if you want a simpler chart, totally simple. You can turn off the buy-sell activity, you can turn off the metrics, and look, there, you have simple support and resistance. That's totally fine. Very, very simple to use the toolkit. And then, of course, we have swings as well. So as I previously mentioned, internals are smaller structures, swings on a higher time frame. They're not a higher time frame, but higher structures, just longer distances, more candles taken into account. So you also see this mitigation method option. So mitigation in basic terms means the order block has been dealt with. It's been dealt with. The price has hit it. It's gone through it. It's ignored the order block, or it's absorbed all the orders. It means the order block is no longer relevant. So it's a question of when do we decide that the order block is no longer relevant. So we have 3 options. We have close. So the close option will remove the order block when the price closes above its top. So it removes when the price closes above the top of the order block. We have a wick. So if the candle wicks into the order block, we mitigate it. Or we have average. So the average option will remove an order block once the price crosses the average level, which we can see denoted by that dashed line. It's very, very simple to use. And then the final option we see is hide overlap. So we'll see that sometimes the order blocks do overlap because here we have an order block and here we have an order block. And it can sometimes be hard to read the data. One's behind the other, we don't know which to look at. It's useful to have both because we see confluence here. Because we have two order blocks here, it may act double as strong. However, if you find this annoying or confusing, you can simply click hide overlap, and what this does is it will just remove the latest order block and it will show the older one. So now we have a cleaner order block structure. Very, very simple to use. Now let's go into the liquidity concepts. Here we have trend lines. Most traders know what trend lines are. These draw liquidity trend lines where there's a lot of liquidity found. So you can see they act as a support and resistance. Here the price bounces off of it, bounces off of it, bounces off of it. How can we trade a trend line? Well, when the price breaks down out of the trend line, great opportunity for a short. Amazing opportunity for a short there. When the price breaks above a trend line, great opportunity for a little long scalp. And these act as support and resistances to the price action. They're very, very simple to use. So we can see when we break down a trend line, good opportunity for a short. When we break above and through one, it's a great opportunity for a long. And then for those of you who enjoy trading patterns, we have pattern detection in the toolkit. So you can enable this by ticking patterns, and then we see a dashboard appear, and we can see it's detected a symmetric triangle, and it will draw it on your chart for you. And I'll leave a link in the description to how you can trade patterns, but they're an interesting concept in trading. And this number next to it will adjust how far it looks back, so the amount of candles it will look through. Normally we recommend 5 as a default. And the final liquidity concept is liquidity grabs. So you can see here I've enabled it, and we see a blue box on the bottom of this wick, and that highlights the occurrence where trading activity took place in a more liquid area. So this area of the market is really acting as possibly an area where a reversal might occur. So in simply put, you can use this blue box as a long signal. So you see this candle has a blue liquidity grab below it. That is a great opportunity for a long. Consider that a bottom signal. So when you see that, you can think to yourself, hey, maybe the market is going to reverse. You can see it over here. You can see a little reversal here. Of course, it's not right 100% of the time, but it's nice for scalps. We see here a massive red liquidity grab. Real time, perfect opportunity for a scalp because we go further down. You can enable it on your charts and you can look through. They are great indications. And the nice thing is they're very clean on your chart. A nice blue liquidity grab showing there's liquidity down here. We reverse, red, we go down. These are 100% real time, really popular feature to use. Very simple. So next we come to imbalance concepts, which is the next area. And I've turned on the fair value gap. So let's start with fair value gaps and we'll work our way through it. So imbalances. The market, what we assume is balanced. It behaves according to some rules, and if we see the markets becoming imbalanced or unfair, we can kind of analyze that in basic terms. So a fair value gap highlights an imbalance from 3 candles where the outer candle's wicks fail to overlap the central candle body of the middle one. So we see here the wick of this candle, this first one, doesn't cross the middle of this big candle, and the upper wick here doesn't cross the middle. So we get a fair value gap because this is a large piece of price action. And what we assume with fair value gaps is the price revisits that area in the future. So what we see here is a fair value gap labeled in real time. We come down, but what we see is we know there's a fair value gap. So the price needs to revisit that area to correct itself. So we come back up and we visit the level that the fair value gap was at. So we can see it's actually at this level. Now, I don't particularly recommend doing this, but we can see the extend box option to extend the gaps all the way. So I've extended it by 30 just to highlight the fact that we came down and we now want to revisit this fair value gap to fill the gap that we left in the market. Now, the next two are a little more advanced, but I'm going to cover them briefly. We have activity asymmetry, which is an imbalance between the market liquidity and volatility. So this needs volume to be detected, but you can see here it's labeled the same, and the concept is the same. The market needs to revisit this area. So we see this activity asymmetry. We start going down. And maybe we were thinking about entering a short position, but because there's asymmetry here, we need to come back and fill this. We need to correct what the market's done in this area, and then we come back down. So the last method we have is the balanced price range, and this just occurs when two fair value gaps overlap. And it's the exact same concept. The price needs to revisit this area, retest it, and refill the market. Now, let's turn back on fair value gaps and let's look at the mitigation method. So as previously mentioned, this is mitigated once an imbalance area has been filled. And you can determine the condition for when these disappear. So for example, mitigated at the moment, so these fair value gaps will disappear when the price revisits and crosses the average at the moment. So I've got it selected as average. So when it crosses the midline and it's filled and it's revisited that area in the market, it will disappear. We can say when it's closed through it, when it's wicked through it, or we can say never mitigate them. So they're never ever mitigated. And we can go and we can use multi time frames here. So you can look at fair value gaps on different time frames. Imbalance concepts are a high level concept. So if you're a beginner trader, maybe consider learning the basics and then moving on to this. The next feature we come to is the premium and discount zones. These are extremely simple. So all these are showing is premium areas and discount. So premium is where the asset may be overbought or overpriced. You're buying at a really expensive rate. And discount is when it's cheaper. It's on discount. It's on sale. So here we see the asset is at 86% discount. So this means that asset is relatively cheap to buy at the moment. So because it's near this area and it's fairly discounted, it's basically telling you, hey, now may be a good area to buy. If you saw the asset trading at a premium, maybe 90% premium, you'd want to be looking for short positions because you know it's very expensive at the moment for that asset, so you may not want to buy it. And then the equilibrium is just the balance points between those. It's just simply the middle where it's fairly priced and it's the baseline for the market at that current range. The next section we come to is accumulation and distribution areas. So these show ranging area of the markets. So once enabled, you'll see a zone appear and it will say, hey, this area of the market was ranging, and we can see it draws a zigzag in for us and it shows, hey, this is an area where people may have been accumulating an asset, and then we go on a little bit of a run because people were buying at that level. It's basically highlighting market structures where accumulation or distribution may have occurred. You see there may be some accumulation down here, some distribution here, and we see the market really respects that. We accumulate, we go on a run. We accumulate, we go on a run. We distribute, we go on a little dip. So it shows ranging areas of the market where people might be buying or might be selling. Then we come to the highs and lows multi-time frame. So this can show us the highs and lows on different time frames. So if we want to look at the highs and lows on the daily, we can select that and it shows us, look, previous daily high, previous daily low. So what can this tell us? Well, if this was the previous daily high, we can treat this as a resistance. So the price during this day, for example, you may want to sell when it reaches near the previous daily high because that's the highest it reached the day before. So maybe today it will do the same. And the previous daily low, maybe this is an area you want to long because the price didn't go below that yesterday. So it's a very, very simple concept. So people use that as support and resistance. Some people, for example, may like to look at the Mondays. So if we enable the Mondays, it's going to show us the previous Monday high. So this Monday's high and the Monday low, because that's the time the market may have opened or whatever, and we use that as a support and resistance. You see, you may want to sell when it reaches the Monday high, or you may want to buy when it reaches the low. Very straightforward to use. And you can see here, you can look at the weekly. Look, let's turn on the weekly. And this was the previous weekly high and the previous weekly low. So it's showing really nice areas of support and resistance. And then we come to a bunch of styling options where you can change maybe how the order blocks look. So for example, you may not like the font size of the order block. It's getting a bit in your way. You can change that maybe to tiny, and you see what it's going to do. It's going to shrink them really down, so you can refine that, and you can move the pattern detection dashboard location, and you can really customize that in your own way. So let's say you're really a beginner, or you're really just a simple support and resistance trading kind of person. What would I recommend? Well, I definitely recommend order blocks to be turned on. Those are really useful. And I'd also recommend hiding the overlap, because maybe you don't want that mess on your chart. You want really clean support and resistances. That's totally fine. The internal buy-sell activity I find useful personally, but maybe you'll want to disable that just to make it a bit cleaner. The metrics I feel like are very important. You look for those higher percentages as stronger support and resistances, and you're getting this really clean support resistance setup on your chart. If you understand market structures, you can turn them on. Be my guest. I'm just showing you how to set up a really basic configuration for those who ask, hey, I want a simple setup. Let me have a simple setup. So I'd also recommend trend lines, because everyone likes to trade trend lines. They're very simple to use. They're great. They're a great basic part of technical analysis. If you don't like the colors, you can change them here. Let's say I want my bullish trend lines to be green. I can select that here. I can turn them to green trend lines very, very, very simply. Very easy to do. And I would also recommend turning on some liquidity grabs. You can see I've got these boxes displayed for tops. Like when it's red, remember it's time to sell. When it's blue, maybe it's time to buy. And we can look for confluence here. Just as an example, we saw an order block here. We see a liquidity grab. Maybe the price is going to come down, and we see a liquidity grab on this order block around this area. Hey, maybe it's time for the market to bounce. So I really hope this video showed you how you can use each of the features of the LuxAlgo price action concepts toolkit. It's really effective, really versatile. What I suggest is exploring which things you like in it. Toggle some stuff on, some stuff off. If you put a bunch of stuff on at the same time, it may be a little overwhelming. So turn on a feature, see if you like it, turn off a feature if you don't like it, and really take this toolkit and turn on what you like. So thank you for watching. Let me know in the comments what you'd like to see me cover next, and have a good day.